Anyway, let's jump right into my presentation today. We've been talking about options the last couple of presentations here, and what I'm going to share is really can be applied to various markets. I do this with the stock market, but this can be used for futures and Forex and really anything that you can chart. And that is about Fibonacci, very popular method for measuring market geometry on charts. So a couple of quick rules here. You're welcome to type in any questions that you want, but I won't be actually answering them until the end, and that's just because we're on a time schedule since we have a lineup of speakers, and also obviously we have a set schedule, so I got to keep to that. I got to make sure that I'm done on time. And Reed, just to make sure, I'm going to be done at 3:30 Eastern time. Is that correct? Just want to make sure that I stick to this schedule here. I've got about 40 minutes. I believe that's correct. Anyway, if you need to cut me off before that, feel free to jump on in. But I'll try to be done by that time. I believe I have 45 minutes. Okay, also very, very, very muy importante. No trading with money you can't afford to lose. That means, please, in the name of all that is holy, do not trade money that you need to put a roof over your family's head, food on the table, gas in the car, for your retirement account, for your kids' college education. Only trade with what we call discretionary money, because trading is very, very risky, and you should not put that type of money at risk. So this is so important. I can't stress it enough. All information in this presentation is for educational purposes only. I'm not going to be giving you any specific buy or sell advice, so use all this information at your own risk. As I said, trading is extremely risky. The fact is most people do not make any money. Please be aware of that. The most important thing for you, if you're, well, whether you're new to trading or not, it's very important to always keep in mind that trading, even if you're a professional trader making all kinds of money, every trade you take has risk. So learn about risk management and money management. Those are the two things that professional traders live and die by. Hopefully just live. Also, please understand that trading is a profession. Well, I should say, as it says there, successful trading is a profession. So here at Top Dog Trading, we do not allow any get-rich-quick mindsets. Trading, some people make a lot of money trading. Most people don't. The way to make a lot of money is to treat it like a real profession, just like any other real profession, meaning get a great education, be a good student of that education, study hard, learn the nuances of all the different, whatever you're trading, and give it time. Give it time. Don't expect it to happen overnight. That would be unrealistic. So come in with your eyes wide open and with realistic expectations. Okay, there's my ugly mug. Reed did introduce me already. A couple other things here. I'm the author of Trend Trading for Dummies. I've received Reader's Choice Awards from Stocks and Commodities magazine. I'm a contributing author to several books. I work with other trading companies and train their traders, and exchanges and software companies, and so yeah. Okay, so there we go. We'll just get right into our topic. All right, so here we go. Now, what we're talking about today is Fibonacci, and Fibonacci is a sequence. In fact, let me bring up my little laser beam pointer here. So these numbers on top in the header, that's your Fibonacci sequence. It's a sequence of numbers, and I'll show you how they're mathematically calculated in a minute. But before I do that, what I found is, in the past, I've done this webinar a couple of times before, and I started out just explaining the numbers, and I found that what I really need to do is give you the context of how they're used first, so you can see the application, why we use these, and then I'll go into them. So, and then we'll have the vast majority of our presentation about the practical use of them in trading, primarily using charts for trading. So here's the bottom line as to how they're most oftenly used. So you'll choose a impulse move. That means a major move in one direction or another. In this case, it's down from this high to this low. And most people will use these as retracement levels, in this case of resistance. So the question would be, all right, we've got this down move, and so we're thinking, all right, this should be, I'm looking to go short this market. And the market bounces back up and retraces back toward its original position where it started its down move. And the question is this: where do I expect it to go and retrace and then continue its down move? Where do I want to short this market to get back in the direction of the impulse move, which is down, but now it's moving against that original move? It's a correction. Where do I expect this correction to stop and then continue back in the direction of the trend, being down? So what we do is we put in various levels that are percentages of that retracement. So obviously, here's the end of the impulse move, so it's retraced 0% back in the direction of its original move. Okay, now if it goes to this level, that's 23.6% retracement. Here, the red line, that's 50%. So it's retraced 50% of this downward move, half. Right, 61.8, 76.4. And that's it. So here it goes to 50% and then continues its down move, goes back in the direction of the original trend. And that's one way. We're going to talk about other ways to use it, but this is the primary way that most people use Fibonacci, is for what percentage of that initial impulse move do we expect the market to correct and then continue in the direction of the original trend, so that they would know, okay, I want to enter here and then go short. All right, so we're looking at these percentage retracements. All right, now, having said that, we're going to look at some more advanced stuff too, and not just Fibonacci retracements. So, how are these, where do these numbers come from? First of all, they're a sequence of numbers, as I said, named after Leonardo of Pisa, who's known as Fibonacci, which means son of Pinocchio. He introduced the sequence to the Western world in 1202, but the sequence had actually been used in India long before that. Now, what are these Fibonacci numbers? Well, they're simply a sequence of numbers that you take the sum of the previous two numbers and add them together. So here we go. Very simple. 0 plus 1 equals what? 1. Okay, pretty easy. And in fact, let me just, let's see, I'll bring up my little pen here. And what color should we make this? We'll make it red. Red stands out. So what you do is the previous equation, you take the last two digits and you add them together. That's all we're doing. And it equals 2. All right? So that's how simple this is. And you can just keep doing this. And then from this one, you take 1 and 2 and you add them together and you get 3. And then that one, you take 2 and 3 and add them together and you get 5. Then you take the last 2 there, add them together, 3 and 5, and you get 8. All right, so you get the idea. So these numbers are the numbers in the sequence then. 1, 2, 3, 5, 8, 13. And you see them up here. 1, 2, 3, 5, 8, 13. And it goes on. It goes on for infinity. So that's how the numbers are calculated. And it's that sequence of numbers. Okay, pretty simple. Now, why are the numbers considered significant? Because as mathematicians and scientists started to study the structure of nature, they found that these Fibonacci numbers are actually an organizing principle of the geometric patterns found in natural phenomena. So when you study flowers and fern leaves and nautilus shells and all these different things, they found that the geometric patterns are actually based on Fibonacci numbers. So they decided that Fibonacci is at the very core of nature itself. Everything in nature is structured based on these numbers. Now, some people will actually use these numbers in trading, use the numbers themselves. However, most people use what we call Fibonacci ratios. They don't use the numbers of the sequence, but they use the ratios. Now, if you're a Gann trader, then you use the numbers in the sequence as well, and that's fine. But today we've got to limit ourselves. We're not talking about Gann today. We're talking about Fibonacci ratios. So how are these ratios derived? Well, pretty simple. Again, each number in the sequence is approximately 1.68 or 1.618 times greater than the preceding number. And that is the foundation of the ratios. That one's called the golden ratio or the golden mean. And the two other key ratios are determined by dividing any number in the series by the number 2 places to the right and 3 places to the right. So let me show you what I mean by that. Here's your sequence. Again, it's actually pretty simple. It might sound like fuzzy math when it's stated, but when I show it to you, it'll be real easy. So 61.8, that is your golden ratio. That's a primary Fibonacci ratio. And how do we get that? Well, we simply start with any number here. So here's our sequence. Start with that one. And you divide it by the number 1 space to the right of it. So 13 divided by 21, there you go, 619. You can take the next two, 21 divided by 34. There you go, 617. 34 divided by 55, okay? And you could do that again forever. Now, there's another ratio, 38.2, and that is often used as well. And in fact, it's very commonly used. How is this one derived? Well, pretty darn simple. Now you take any number in the sequence and you divide it by the number that's found 2 places to the right. So we start again with 13. This time we divide it by 34. So 13, and then we go 2 numbers to the right, divide it by 34. You get 38.2. And the interesting thing is, every time you do this, you get pretty much the same number. Okay? And then the third number, 23.6, is found by dividing any number in the sequence that is found 3 places to the right of it. So we won't go into great detail here, but you get the idea. Let me clean this chart up here a little bit. There we go. So again, if we start with 13, then we just go 3 places. 1, 2, 3, divided by 55, and you get 0.231 or 236. And that would happen with every time you did it in the sequence. So it's very consistent. Those ratios are very consistent. All right. Now, a couple of others that we need to look at real quick before we move on and show you the application on charts. As I said, 61.8 is the primary Fibonacci ratio, the golden ratio. 38.2 and 23.6 are secondary ratios. Now, we also use 50% and 76.4. So where do they come from? Well, there's people who are very dedicated and just very, very literal about everything with Fibonacci, and that's fine. For me and my trading, you got people who specialize in candlesticks and Gann and Elliott waves and Fibonacci, and they go to great extremes and get very detailed about it, and that's fine, and I respect that. For me, I take the basic premise of each one of these things and use them. So for me, 50% is really not a Fibonacci ratio, although there can be an argument made for it, and there has been. But to me, it's simply been observed as a common support resistance level. And so we include it. Now, 76.4 is not really a Fibonacci ratio. It's simply the mirror of 23.6. So again, as we're measuring an impulse move from 0 to 100%, and we've already established that 23.6 is a Fibonacci ratio, then the opposite side of the 50% would be 76.4. Now again, more Fibonacci purists, they use the number 78.6 because they say it's the square root of the golden mean, and that is true. For me, I'm very practical. I'm not so much into the theory of trading or mathematics or any of that. To me, I'm more concerned about what works in real life. And over decades of observation, I've been trading since I was 8 years old. I'm 56. And I've just simply, through observation, asked myself which one of these two seemed to hold better. And I've determined that 76.4 does. But they're so close, it's not really a big deal. You're fine going either way. But I use 76.4 just because I find in experience that it tends to be a little more accurate. Okay, and as I said, it's the inverse of, or the corollary of 23.6. So it's geometrically accurate. So there's a lot of other market geometry. I put this under a big category of market geometry. We've got Gartley patterns, astrology, squares, Gann, etc. We're not going to talk about all of that. We're just talking about Fibonacci numbers today, just to keep things simple. So here are the ratios again. If you want to write them down, if you're not familiar with this already, this is basic 101 stuff. We start with 0. Remember, we're talking about an impulse move. And 23.6, 38.2, 50% retracement, 61.8, 76.4, and 100. Those are the ratios that we're going to use today. All right, so here again is, now let's bring up some charts and let's look at how this is used. So here's an impulse move from this high to that low. All right, boom. Now, the question is, as the market bounces, or as the market retraces, where do we expect resistance to be found? So we draw our, actually there's a drawing tool in most charting software that will actually do this for you. Some of them set these ratios for you, others allow you to set them yourself or to edit them. And here are the numbers we discussed. Simply, what percentage of this move down is the market retracing and correcting back up? So 0%, obviously it's retraced 0. 23.6. Now, here's an interesting thing, very important to note. So here's our level of 23.6. Did the market, as it came back up, even acknowledge that that level existed? No, it did not. It just sliced right through it. Again, 38.2. Did it acknowledge that level existed? No, it just sliced right through it. 50%. Did it acknowledge that it existed? Yeah, it definitely did. It actually bounced right off of that. Now, when the market came back down, all of a sudden the 23.6 it didn't notice before, it puts in a low there. Then when it goes back up, now it doesn't acknowledge 50%. Now it goes to the golden ratio, 61.8, and bounces off of that. And then it acknowledges 23.6 again, ignores 38.2, goes back here. So here's the question, and this is really, really, really important. So these Fibonacci ratios are essentially, they fit into the category of support resistance. But as you can see, the market does not bounce off of every single one, every single time. So that begs the question, how do we determine which of these levels the market's going to bounce off of or just slice right through without any acknowledgement at this time? And this time means whenever you are taking a trade or considering a trade. And that, my friends, is the key to success. Now, the answer to that is using Fibonacci retracements or any type of support resistance, whether it's 52-week highs and lows, whether it's floor trader pivots, whether it's previous cycle highs and lows, major swings. The answer is always, you don't know just based on those support resistance levels. It's not enough information. So you place your support resistance levels on your charts, and then you look for other things to help you determine which one of those levels will hold or not. So we can use these as several things. Number one, entry levels. We can use them for profit-taking levels, and we can also use them for using trailing stops. But alone, they're not going to help us. They're good because they give us, okay, these are the potential entries and exits, but which one will it be this time? And I'm going to go into that. I'm going to show you how I determine which level I expect to hold and which levels I don't. But we're going to have to introduce some other things in order to do that. So let me finish up with Fibonacci, show you some more advanced stuff. Because some of you who know Fibonacci retracements, you're like, okay, this is old hat. That's cool, it is. But you know what? We've got some beginning traders on here too, so we've got to start with that. And then I'll show you some more advanced stuff, and then we'll go into how to determine which levels will hold and which levels will not. All right? So let's take our drawing tool off of here, all our little gobbledygook. Okay, so here's the second tool. Here's the second way of using Fibonacci. So the first one was Fibonacci retracement, where we are looking for where to get in the direction of the trend. Now, Fibonacci retracements are more often used Fibonacci extensions are more often used for profit targets. And it's a three three-part drawing tool. These are all drawing tools that you will find on your charting platform. It might look something like this, a little icon there. Depends on the charting platform. Talk to your broker, your software provider, and look in their help section and find out where that tool is. Now this is a three-part drawing tool. So you start here, and then you draw it down here to your impulse move, just like you would for retracements. But then you're not done. Then you have to click on a third swing high, and that would be over here. Then what it does is, instead of drawing retracement levels up here, it actually draws them below. And this is why we use it for targets. So you got your same ratios, we don't change the ratios on this, but we're looking for targets. So here we have 100%. What that means is, this move from here to here is exactly the same move as from here to there. That's called a measured move, and it's a target that a lot of people look for. It's a very common target for profits, and it's one that you should always be watching. Measured move, 100% of the impulse move drawn from the retracement level. Now again, if we look at our ratios, you can see 23.6. Did the market acknowledge this? Now these are support levels, right? Now they're support. They can be resistance or support. But now it's support. Did the market acknowledge the 23.6? Well, yes, it actually did. It didn't bounce off of it, but it paused at it for 2 bars. And so it acknowledged it was there. Did it acknowledge 38.2? No, it just sliced right through it. Really, we didn't put in a low. The market kind of paused at a few of them, but it didn't put in a low until it got down here to 76.4. That's the one that worked this time. Then it bounced up, and where did it go? 38.2. Then when it finally went down and made its lowest low, it went to that 100%, the measured move. Then when it comes back up, it doesn't acknowledge 76, 61, 50, 38. It goes all the way back up to 23. Then down to 76. And so you can see how, yeah, these levels, they do work, but which one's going to work this time? That's the key. And we will get to that. All right, now, let's just show, so that's another way of using Fibonacci ratios. All right, here's another one. This is very common. It's called using Fibonacci clusters, and you can use them in different ways. I'll show you one right now just to build on what we've already talked about. So we have a impulse move from here to here. And then we draw our Fibonacci retracement ratios. Okay, then we also take that, off of that same move, we'll take and use Fibonacci extensions, our extension tool, because we had a little swing high there and a little swing low there. And then we draw the extension above that high, or above that low. Now, we look for places where the levels come and cluster. So just as a couple of examples, right here you can see this 76.4 and this 38.2 cluster here together. And the 100 and the 23, they cluster in here together. And this is considered stronger levels of support resistance because both tools are giving very close support resistance levels. The reason that works, by the way, is because you have different people looking at different levels. It's not just because there's two lines there. It's actually based on market dynamics. The market is a big auction place, and a lot of people are looking at different things. And the more people that you get seeing a support or resistance level, the more likely that level is to hold because of people's reactions to what they see. That's the whole market logic of clusters. Okay, now here's a Fibonacci tool that not many people use, but I find to be very, very powerful. So far we've been measuring Fibonacci price tools, retracements and extensions for price levels. You can also use a Fibonacci tool for measuring time. So a chart is a two-dimensional object, right? We've got time is measured down here, and price, of course, is on the right axis. And it's interesting because so many people, well, they know that, and they use price for everything, but rarely do I find traders who have any type of accurate timing tool. And that is a huge mistake because, well, a chart being a two-dimensional object, if you don't take into consideration time and you don't have a really good accurate timing tool, you're leaving off 50% of the information on a chart. And how in the world can you have a probability scenario if you neglect and ignore 50% of the information that chart provides? Well, you can't. So here's one tool for you. Again, what we do is we measure an impulse move. So we're going to measure from this low to this high. There's your impulse move. Now, what this does is we're using the same ratios. Okay, this is an extension. These are time extensions. So it's giving us levels beyond the impulse move, which went from here to here. And you can see it on this little drawing tool here. And so now it's going to give us times to expect a shift in the market, a high or a low. And here they are. And it's the same ratios. Same ratios. So here, again, you have to give these things a little bit of leeway. Nothing's going to hit it to the exact second. But we put in a low here. We put in a low here. We put in a high here. And we put in a high here. Now, something to note, again, very important to be very honest with ourselves in trading. We put in a high here, but there's no Fibonacci extension, time extension. So what do we make of that? Well, what we make of that is that Fibonacci time extensions are very good for finding some highs and lows, some shifts in the market. But it's not going to nail every single one. It's not going to nail every single one. Here's a low that it didn't catch. Okay? So what do? Well, we just wait for those times when we have a Fibonacci ratio, and we trade those. Okay? Don't expect anything, any tool, any indicator, anything in the world to catch every move in the market. It just doesn't happen. And we don't need it to happen. All we need are some profitable trades. Now here's another one. This is one of my favorites. This one is really cool. This is a, well, it's called a couple different names depending on your charting platform. Fibonacci circles or Fibonacci arcs. And they're really both the same thing. The reason that it's called two different things is it just looks different depending on the scale. So again, we always start measuring the same thing, an impulse move, from a significant high to a significant low. Now, instead of drawing horizontal lines like our price tools did, or vertical lines like our time tool did, this actually draws curved lines, arcs. So here it looks like an arc. Now, if you were to take that and scale it out so you could see more of the chart, and you pulled it out far enough, you would actually see it is one big 360-degree circle. So that's why some tools call it circles and others call it arcs, because visibly on the chart it's going to look as an arc. But if you pulled out the scale, it actually is a 360-degree circle. So it's really the same thing. Now, here's how we use this. The cool thing about this is it measures both time and price in one tool. So you wait for it to climb and reach that arc, and it'll give you the price and the time to expect a shift in the market. Okay, here's our next arc. We're using the same ratios again. Time and price to expect a shift in the market. Now again, does it catch every single one? No, but it catches ones. And that's all we need. We need some profitable trades. We don't have to catch every single move in the market. Okay, so now let's get to the question that I brought up before. How do we determine which levels will hold? In other words, which levels will the market bounce off of? And which levels will the market just slice right through and not even acknowledge? Or maybe just hesitate a little bit and then slice right through after that. So what we have to do, as I mentioned, is we have to bring in some other tools to the equation. Because the support resistance levels, by the way, even the time Fibonacci tools are support resistance. They're support resistance of time instead of price. So time has its own element of support and resistance. Not a lot of people think about that, but that's true. So what we do is we bring in other energies to the market. When I trade, I use 5 energies. I'm looking for these 5 energies on every single trade. And this is my whole trading method in a nutshell. Number 1, when I look at a chart, I ask myself, what's the trend? What's the overall direction? Number 2, I ask myself, what's the strength of that trend? That's the second energy. Is there a lot of strength in this trend or not? This is where a lot of people who try trend trading fail, and they wonder, hey, how come after I get in a trend, the market stops trending and it goes the other direction? Quite often, it's because they don't know how to measure the strength of a trend. So it's like a locomotive going down the track. That locomotive has a lot of strength to it, and if you put on the brakes, that's like a support level or a resistance level. The market is not going to stop right then, just like that train is not going to stop just because you put on the brakes. Think of support resistance as brakes. But if the market has the energy of momentum behind it, it will slice through that support or resistance level. You have to wait for a support resistance level at the same time that the momentum is dying down or it's completely gone to zero. And we use a momentum indicator to determine the actual value, a numerical value for momentum. When price comes into a resistance level and the momentum is zero, it's very likely that market is going to bounce off of that and not slice through it because there's no strength. And it's usually already been slowing down before we get there. The third energy is cycles, and I use an oscillator for measuring cycles, timing. So we can use the Fibonacci time extensions for that. But the cycle indicator that I use actually does catch every cycle high and low. Now, the interesting thing about that, just because you have a cycle in the market, that's just pure time. And that doesn't necessarily mean the market's going to put in a higher low. It just measures certain time increments. Again, you can't use any one of these energies by themselves. They have to be all used together. Number 4, now that's support resistance. This is where Fibonacci comes in. It is one type of support resistance. Other types would be previous cycle highs and lows, previous wave highs and lows, floor trader pivots, things like that. And then the fractal energy is just a fancy name for saying we use multiple time frames. So if I'm looking at a daily chart, I would also look at a weekly chart of the same market, and that weekly chart I would call my fractal energy. From intraday trading, same thing. I might trade a 5-minute chart, I'd look at a 15-minute chart. That 15-minute chart would be my fractal energy. So the key element here is that trading is all about determining a probability scenario that favors you. And the way I do that is at each point, or potential entry point, I should say, I ask myself one simple question. How many of those 5 energies are aligned saying buy or sell at the exact same moment? Based on that, I give it a score of 1 to 5, obviously. The higher the score, the higher I consider the probability of the trade. And here's the key. We need 5 independent witnesses to establish a preponderance of the evidence. So again, no one of these things means anything. Nothing, including Fibonacci. But when you put them all together, then you have a probability scenario. So each one's important only insofar as it provides one piece of evidence to the puzzle. When all 5 pieces of evidence come together, it's significant. Now, one last thing here. I said at the beginning it's important to treat trading as a profession, and that means getting a good education and being a good student and learning the details and not just the generalities. So here's an example of that, where I say we need 5 independent witnesses. The operative word there is independent. You can't just put 5 indicators on a chart, wait for them all to be bullish, and expect that to give you a probability scenario. No. There has to be a strategy behind this, and the strategy is each one of, first of all, it's not even about the indicators. The indicators are just instruments that measure an energy and give you a value for that energy. It's the energy, and the energy is the flow of money, the buying, the selling. That's the kind of energy we're talking about, the energy of money. Now, the operative word there is independent, as I said. So that means that these 5 energies are very carefully selected because each one is not correlated to the other 4. And that's what makes it significant when all 5 say buy or all 5 say sell. That is the critical piece of strategy. So real quickly here, we'll go through the 5 energies on charts. We can do this fast. For trend, I use a 50-period simple moving average. Is that anything significant in and of itself? No. But again, used with the other energies, it becomes very significant. Some people say higher highs and higher lows are an uptrend. That is not actually quite correct. The dictionary definition of trend is to extend in a general direction. Therefore, you have to use something that measures a long-term move. That's what the terms extend and general refer to. So you can't use a short-term moving average to measure trend. It violates the very etymology of the word. Momentum. Now I'll slow down on this one a little bit because now we're getting to something that a lot of people don't know. So here we have higher high, higher low, higher high, higher low, higher high. 50 MA is up, but trend is always lagging. Trend is always lagging. So here what we see is here's the momentum indicator. So we've got higher high. Momentum puts in a little bit of a lower high. Another higher high, and now momentum's definitely gone down. But also on the low, a lot of people look for divergences. I'm not big on divergences, but here's the key. On momentum, we've got a lower high and a lower low. On price, we have a higher high and a higher low. Momentum, unlike trend, momentum tends to lead price. Why? Because quite often markets slow down when they get to their tops. Okay, and there's a lot more we can talk about with momentum. It is a very, very powerful energy. I love it. Same thing here. It can be leading. A little higher high, lower high. Same thing here. Lower low. And that's the key, is to see both. Here's your cycles. This is just a basic outline of my cycle indicator. It's a little more sophisticated than this, but just to give you the idea, cycles are the timing or the rhythm of the market. So, low, high, low, high, low, high, low, high. Markets wiggle up and they wiggle down. They don't go straight up or straight down. So timing your entries is key. Why? So you don't get stopped out so often. If we're going short, we want to short the final cycle high before the market continues down. That's the key. And by the way, as I said, there's only 2 parts to a chart, time and price. W.D. Gann said of the 2, timing is actually more important than price. So do yourself a favor and definitely learn about timing. Now, but timing, again, by itself doesn't work. Here's a cycle low. I wouldn't want to buy that. Why? Because it doesn't really go anywhere. There's no range to that market. Why is there no range? Because there's no momentum. Trading cycles without momentum is foolish. It still measures timing, right? But timing does not measure strength. Here's our support resistance example with Fibonacci, impulse move. Now, here we go. Here's a good example to show what I'm talking about. Resistance here, we get a nice topping candlestick pattern. Cycle, well, first of all, the 50 MA is down. That means the trend is down, even though price is above it. Cycle indicator turns red for a time to put in a high. Momentum, it's a little bit above 0, but it's not very much, is it? It's weak. Weak. As the price went down, momentum was strong to the downside. It's weak to the upside. So again, all the energies together indicate that is the time and price level. This is the resistance level that is likely to hold. And the 5th energy is the fractal energy. Again, simply looking at the next higher time frame. Here's a 2-minute chart. Here's a 6-minute chart. This would be my fractal energy. And all I'm doing is I'm looking here at my setup chart. Trend is down, number 1. Number 2, this is the 15 EMA. It's holding as resistance. Number 3, we've got a cycle high. Number 4, momentum is below 0. So for going short, that's good. Momentum is bearish. And then number 5, we look over here. And for the fractal energy, what I need is for momentum to be going down, not trend. A lot of people use trend on the higher time frame. I use momentum to confirm the trade. 1, 2, 3, 4, 5. And that's all I do in my trading, is count to 5 all day long. So it's a very robust and adaptable method. It works for all the markets that I trade. I trade stocks, commodities, options, currencies, and futures. I invest, I swing trade, and I day trade. It's very simple. It's very objective. You can count to 5. You're on board. So here's my offer for today, and I'm not selling anything today, unfortunately. You could ask me to, sell you something, but I got nothing to sell you. So what I'm going to do is just give you a free course today. My free course today is the 5-day video correspondence course that I offer. You get 5 days of video instructions. So over the next 5 days, you get a video a day. That's why we call it a correspondence course. After each video, which is about 15 or 20 minutes long, there will be a little interactive multiple choice quiz to make sure you understood everything. On day 4, I give you an extra bonus, and that is one of my actual favorite trade setups. And I include the rules and the filters with that so that you can start trading that. It's called the rubber band trade. And it's my gift to you to, again, it's totally free. Try it out. Trade it. I would recommend please do it on a simulator or demo account. Don't risk real money with any new thing you do until you have tested it yourself. But this one is a winner. I use it all the time myself. I still trade this setup every time it occurs. And I think you're going to love it. It's a scalp trade. Now, I know a lot of people are asking indicators, and that's normal. Obviously, I have no time left, so we're at the bottom of the half hour here. So next week, I'm going to be doing a webinar. I think it's Monday or Tuesday of next week. Yeah, it's Monday of next week. And I'll be giving away my cycle indicator at that webinar. So you guys will get it absolutely free. There's no charge for the webinar. I do actually charge for the cycle indicator, but if you come on that webinar, I will give it to you for free, and I will give you a free tutorial on how to use it. So to get all of that, just simply go to this abbreviated bit.ly URL, and you can get the correspondence course, and by doing that you'll also get the invitation to the cycle indicator webinar. So that's it. Thank you very much to Reed, and thanks to everybody who's here today, and appreciate your time. And if you have any questions, by the way, since I didn't have time for questions, feel free to send me an email at barry@topdogtrading.com, and I'll type that in here real quick. And then I got a skedaddle, barry@topdogtrading.com. Whoops. Nope. Nobody said you have to be able to type to trade. barry@topdogtrading.com. There we go. Okay. So yeah, sorry you didn't have time for questions, but feel free to email me with any questions you have, and I'll be happy to answer them. So great. Thanks, everybody.